Hey there, and welcome. So let's talk about stock options. You've probably heard the term thrown around, and maybe it sounds a little complicated. Well, the goal here is to totally demystify them. By the end of this, you're going to get a really clear picture of what they are and, more importantly, how they work.
So let's just jump right in with a big question. What if you could control, say, hundreds of shares of your favorite company, but for just a tiny fraction of what it would cost to actually buy them? I mean, it sounds a bit like a financial superpower, doesn't it? Well, that's pretty much what stock options let you do.
And to really get how that superpower works, we got to start from the ground up. We're going to begin with something we all know and understand, a regular old stock. And then we'll see how options are built right on top of that foundation. All right, let's start with something we all know, a stock. It's just a small piece of ownership in a company, right? Simple. This is our starting point.
Okay, this slide lays it all out perfectly. Think of it like a pyramid. At the very bottom, you have the stock itself. That's called the underlying asset. Now, sitting on top of that is something called a derivative. It's just a contract that derives its value from the stock below it. And an option? Well, an option is just a specific type of derivative. So the key takeaway is, an option isn't the stock itself, it's a contract about the stock. All right, so we know it's a contract, but what does this contract actually do? Let's get to the core idea. And here we go. A stock option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a set price before a specific date. Now, I know that sounds a little textbooky, but every single word in there is crucial. But there's one little phrase that is the absolute key to this whole thing. And this is it. This is the magic phrase. The right, but not the obligation. Think about it. When you buy a stock, you're all in. You own it. You're committed. But with an option, you buy a choice. You have the power to act if you want to, but you can also just walk away. That flexibility is what you're paying for. It's the power of choice without the commitment. Okay, so you have this amazing choice. But what are your choices exactly? Well, in the world of options, it really boils down to two fundamental directions, two bets you can make on where you think a stock is headed. Your two choices are calls and puts, and it's actually super simple. A call option gives you the right to buy a stock. You would want this if you think the price is going to go up, so you can lock in a lower buying price now. On the flip side, a put option gives you the right to sell a stock. You'd want to put if you think the price is going to go down, so you can lock in a higher selling price. A really easy way to remember it: calls are for the bulls, puts are for the bears. Now, just a quick technical note, there are two styles of options, and it's all about when you can use your right. European style means you can only exercise it on the final day, the expiry date. American style is a bit more flexible. You can exercise it anytime you want before it expires. You'll see these labeled like CE for a European call or PA for an American put, but honestly, the main idea of a call or a put stays exactly the same. All right, awesome. We've got the big idea down. We know what an option is, and we know about calls and puts. Now, let's roll up our sleeves and look at what's actually in the contract. There are four terms you just have to know. First up, the strike price. This is that predetermined price we keep talking about. Think of it as the price tag that's literally glued to your contract. No matter where the stock price goes in the market, up, down, sideways, your contract's price is locked in right here. Next, we have the lot size. With options, you're not dealing with one share at a time. They're traded in bundles. One single contract controls a whole bunch of shares. So, for example, if you buy one options contract for Infosys here in India, you're not controlling one share, you're controlling the rights to 500 shares. So what does it cost to get this amazing right? That's called the premium. It's the price you have to pay per share to buy the contract itself. This is basically your ticket to ride. It's the cost of getting that powerful right without the obligation. And here's where it all clicks into place. Let's use our Infosys example. If the premium is, say, 5 rupees per share, and we know the lot size is 500 shares, well, you just multiply them. 5 times 500 is 2,500 rupees. That's your total cost to control those 500 shares. And that right there is the superpower we talked about. It's called leverage. You get to control a huge asset for a tiny fraction of its actual price. And finally, we have the expiration date. Every single option has a shelf life. It doesn't last forever. Think of it like a carton of milk in your fridge. It's got an expiration date. After that date, the contract is worthless. Poof, your right just vanishes. So time is always ticking. Okay, That was a lot, I know, but we've covered all the key pieces of the puzzle. So now let's put this entire thing together and see the full picture.
So, let's recap the whole thing in one big sentence. You ready? An option gives you the right to control a lot size of shares at a fixed strike price for which you pay a premium, and this whole right only lasts until the expiry date. That right there is the heart and soul of a stock option. You know these 4 terms? You understand the core concept. So now you get it. You know the rules of the game, you know what the pieces are, you know how they move on the board. But knowing the rules is just step 1, isn't it? The real question is, how do you use these tools to build a winning strategy? And that is the next level of the game.